RSMR have built a strong reputation in fund research, and that's been based on fundamental qualitative research. That's culminated in our ratings, and we've been doing that since 2008. 2014 we introduced our SRI ratings, which has leveraged the same fundamental research into those, and that's launched our SRI ratings. That's continued up to date, where last year we launched our discretionary managed portfolio services. We include 3 ethical mandates within that, and we go through the same process of looking in depth into that. Those portfolios are available on platforms, so this is the only little bit of sales I'll be doing. My colleague John will be around to speak to you if you wish to talk about those. But within our client base, we have 3,500 IFAs who use our research as the bedrock of their investment proposition. And talking to them, there seems to be still a little bit of confusion, one within some of the terminology that the industry uses, because there isn't a standardised terminology across the industry. But also some are worried about whether they may be giving up investment performance in investing in an ethical portfolio, or whether there's an increased risk. So hopefully, I would like to tease out from the panel over this session, getting an answer to some of those questions. But first, I'll introduce you to them. We'll be hearing from Luciano Diana, who's the Senior Investment Manager at Pictet Asset Management, and the manager of the Global Environmental Opportunities Fund. We'll also be hearing from Neil Godin, Head of Equity Quantitative Analysis at Keynes Capital, but he's also one of the fund managers on the Global Sustainable Equity Fund. But first, we'll be hearing from David Harrison and Kate Elliott from Rathbones and Rathbones Greenbank. David is the manager on the Global Sustainability Fund, and Kate is the Senior Ethical Researcher at Rathbones Greenbank. So if I can hand over to you.
Perfect, thanks very much. So both Kate and myself are here, and I think that's quite important from our approach. I think those of you who know Rathbones and the interaction that we have across the group, it's very collaborative, so I think it's quite good both of us are here. Brief background, Rathbone Sustainability Fund was launched in July of last year. We've had the Rathbone Ethical Bond Fund running for a number of years, and we use the same process on the equity side. We work very closely with Kate. I guess we've got a short period today. We're going to talk about our approach, and I was going to start with our philosophy, what sustainability means to us, and then we're going to probably talk about the UN SDGs and leave you with a couple of examples as well about the kind of companies that we own and we would class as sustainable. I guess as a starting point, it's already been mentioned. I think there's still confusion in the industry about terminology. I've been involved in sustainability for about 13 years, and it's been amazing actually how the different terminology, it used to be all SRI, you have ethical, sustainability, impact. I think when you're involved in the industry, you understand it, but it can be confusing. And when we launched the fund, we wanted to kind of be very clear about what sustainable investing, what is a sustainable company. And for me, there's kind of 3 things that make sustainable returns, the 3 things we look for. First thing is this idea of a durable franchise. I talk about this a lot. So basically, you start with a good fundamental business. I think that if you don't have a good fundamental business, you're going to run into trouble. So by that I mean, if you look at the companies that we own, kind of market leaders in terms of what they do in their industry, probably very cash generative, management teams that can think over multiple economic cycles, and generally will have characteristics that they have high levels of research and development in-house, will generate strong internal growth. Secondly, it's really important that there is a clear solution or impact that company is providing. I often use the phrase, kind of the idea of walking the walk. I think where we find and what we find really important is you have to meet senior management. I probably meet 300 companies a year. I will ask the CEO of a business, can you explain the UN SDGs? How do they link to your business? Because it's amazing, you walk into a company presentation, they've got the UN SDGs plastered all over their website, but then they can't articulate how that's benchmarked back to that, how they allocate capital. And the third thing is around corporate culture. It's kind of nice fuzzy warm word culture, but there's a high correlation between strong culture, strong sustainability. So those kind of three things are what sustainability is to us, and that's how we kind of look at every company and how we build the portfolio.
So as David's mentioned, when we're looking for sustainable opportunities, sustainable companies, the primary lens that we are looking through for that is the UN Sustainable Development Goals. I'm sure most, if not all of you, are very familiar with the UN SDGs, but just a quick kind of refresher or primer for those who may be less familiar. So these are 17 headline goals. They were agreed and adopted in September 2015. They cover a range of issues from gender equality, life on land, health and well-being, but all with the overarching aim to eradicate poverty, protect the planet, and increase economic opportunities for the entire population by 2030. So a really, really ambitious set of goals. And they've really kind of become embedded into the way in which companies, governments and investors are thinking about sustainability issues. So within the fund, we look to identify companies that are helping to positively contribute towards the achievement of one or more of these goals. And that can either be through the products and services that those companies are providing, or through the way in which they're operating, so the way in which they're treating their employees, they're interacting with their wider stakeholders. And importantly, we're not just looking at the positive aspects. We've got quite a high hurdle that we would expect companies to pass from that positive point of view, but we're also very, very aware of the fact that all companies will have positive and negative impacts. So as a first step, we're ensuring that any companies that get into the universe are not having a materially negative impact on any of those SDGs. And the fund has got a really strict set of screening criteria that will exclude kind of common ethical concerns, but also anything that we feel is not meeting that minimum standard of avoiding significant harm. So in this way, we really try and take kind of a net approach to sustainability risks and opportunities, really understanding which companies are those leaders that are delivering net benefits for people and the planet. In practice, within the fund, when we're looking at the SDGs and how we kind of map that down to individual companies, we don't do a one-to-one mapping. We've got an intermediate set of 8 sustainability themes. We've got some little booklets just at the side there. So within that, it's got a graphic which will show you how all those different multiple SDGs will map across to our internal themes. But to give an example, so SDG 8 on decent work, that will map across to our themes on inclusive economies, on innovation and infrastructure, and of course our theme on decent work, as you would expect. And also within the handouts, you can see a kind of a breakdown of the fund's holdings by theme at a recent date. You'll notice that not all of those 8 themes are represented within the fund's holdings at the moment. That's because we don't take a thematic approach to investment. Rather, we're looking holistically, we're looking globally for the companies that are good financial opportunities, as David has mentioned, that is crucial, but also the ones that we feel are genuine sustainability leaders and are best placed to effect real change in the world. I think we'll just end with a few examples of that just to bring it to life and what we mean in practice.
Absolutely, and I think it's really important, as Kate says, that we're not bound by a specific theme. So if you look at the fund and the case study document, we have themes that come out, but we are, that point I think is really important to us, that everything we own is there on its own merits from a financial return point of view. So I think a good example, around a quarter of the fund is exposed what we kind of tag health and well-being. I think this is a really interesting area. Clearly there's lots of structural shifts in this area, everything from demographics, some of the challenges we must solve in the health and kind of well-being space. One name I like to talk about is a company called Christian Hansen. It's a Danish business, it's specialty chemicals. Then what's interesting, again, if you look at both sides, from a fundamental point of view, it's a brilliant business. Christian Hansen's been around probably for over 100 years. It operates in a duopoly. There's only kind of 2 companies in the world do what they do. Has multiple year relationships with its clients. And what they make is essentially the cultures and enzymes. So you buy a Danone yogurt, you buy something else, it will have a Christian Hansen enzyme in there. So that's interesting. But then there's a big shift away from antibiotics to probiotics in humans and animals. They have very high market share there. So from a fundamental point of view, they're excellent. From a sustainability point of view, if you look at the UN SDGs, they've targeted I think 3 SDGs, and they can explain to you, why that drives their business and why it's kind of critical to capital allocation. Another area, I think, which is very thematic, is innovation and infrastructure. Electric vehicles gets lots of kind of airtime. If I'm honest, we struggle a bit here because you see lots of thematic ideas, but very few that make fundamental sense. A business we own in this space is something called Aptiv. This is a really smart management team that actually span out all exposure to the combustion engine. So now they essentially become the nerve centre of your vehicle. And if you think about the trends, we've got vehicle electrification, active safety, more kind of sensors in a car. So you're not just buying on the kind of that vehicle autonomy argument. You've got multiple drivers, you've got a great management team, and again, no kind of legacy exposure to the combustion engine. So we've got lots of examples. There's 2. I hope to give you a flavour where we're looking. Where we spend the most time, if I'm honest, is actually speaking to the companies doing this work. We'll spend up to 6 months looking for these ideas because there are lots of them.
Thank you very much. Moving on now.
Yep, so I'll crack on. Hi everyone. I'm not going to go through our fund in too much detail because there'll be a lot of common themes you've heard in terms of how we look at a fund, how we look for sustainable stocks. So rather than have the exact same stuff, I'm going to crack on straight into a couple of examples because I think it's important. Where we would differ maybe slightly is we look for more sort of growthy stocks that are maybe earlier on in the process than you've just heard about. We call them improvers. We have some leaders as well, but we're happy to invest in companies that we believe are going on that journey to becoming a leader. Sometimes that's because they've got religion, they've decided to change their business. Often it's just because they're young. These companies are young and immature, and the leaders will have a big group of people filling out the right forms, to get themselves up to date, and some of these young companies are scrabbling around, really growing fast. We also look at things in terms of products and practices, and we score things on a 1 to 5 in terms of products, and really we're looking for products that are up there. They're there to change the world, they're there to do things that really help improve, whether it be environmentally, health and well-being, education, all those things that you'd want to see. We're looking for those types of companies. A couple of examples I was going to go through is I'm sure everyone in the room, and I wasn't, by the way, before I say this, it was aware that yesterday was National Hydrogen and Fuel Cell Day. One that's quite niche-y. I didn't see many balloons out or anything, but it gets worse, because the reason it's on the 8th of October every year is because that's the 1008 is the atomic weight of hydrogen, apparently, and I found that out on Google last night. So, if ever you're really bored, go and read about National Hydrogen and Fuel Cell Day. But generally, what intrigues me about hydrogen is it's something that shows off our process in quite a good light. We work very closely with our ESG team, similar to what you've heard, and actually this was an idea driven by them, not by us. So from maybe 3 years ago, when we had this process of fund managers doing fundamental work, an ESG team doing ESG work, and never the twain shall meet, the impression that maybe there's a bit of an enemy versus them and us situation. It's morphed into a scenario where we're all singing off the same hymn sheet. We're all doing things for the same reasons. And hydrogen was an example of Ryan emailing me, and it highlights a couple of things. He's emailed me and said, have you looked at any of these hydrogen stocks? There's nothing on sell-side research about hydrogen. It's died. It happened 10 years ago, and nothing's happening now if you believe the sell-side, because they're not really that interested, which highlights why do we play sell-side. But, that's a different argument that we can debate. But, Ryan emailed me, I started to look into the subject and started to get really interested. Both, and at this stage we're dinging each other back in terms of what a hydrogen economy could look like, what it means for EVs. One thing that's frustrated me as I've done that work this year is there's this constant battle between batteries and hydrogen. I mean, why? Shouldn't it be EVs against combustion, end off? We're going to need everything to try and fight against climate change. So there's space for both of them. They've both got different strengths and weaknesses depending on the usages out there. So you have to be very careful about having that. Interestingly, there's a boat that's just come to London. I don't know whether you've seen it in the news this week, called Energy Observer. Energy Observer is a boat that combines everything, right? So it combines batteries, hydrogen, solar, and wind. And its plan is to travel around the whole of the world for 2 years. It's been doing it for almost a year already, and live just off that renewable energy, and it's doing it no problem. So when it's windy, it uses the wind turbines. When it's sunny, it uses the solar, and when it's got too much energy from those two, it changes it into hydrogen and stores that for when there is no sun or there is no wind, and uses the hydrogen then. Very clever, very simple, very easy. When I did the work on hydrogen, I then looked at what type of stocks we could invest in. And a lot of them are very small and very illiquid, and that's where you come into a bit of a problem. But there was one company I found in the US called Plug Power, and the more I read about them, the more intrigued I got. And the reason I got intrigued was, actually they've already got 30,000 vehicles working today that none of us know about, working today in environments. Now, their two key clients are Amazon and Walmart. And when I got really interested, and this is when the power of sustainability really hits home to me on multiple fronts. We're bottom-up stock pickers, just like you've heard, but when you can find stocks that are combining doing something better, greener, and cheaper, and more operationally efficient, what is not to like? So Walmart are actually on record as saying, when they introduce these hydrogen forklift trucks into their warehouses, they save 20% in operational efficiencies pretty much within a couple of months. Why is that? It's because historically you've used lead batteries in forklift trucks. Over the period of a shift, they degrade, so you don't get the same usage in the first hour that you do at the end of the 8-hour shift. That's not great. You don't get that problem with hydrogen. You also need to store lots of lead batteries and change them over. So you need more staff, more storage space, and they're not very good for the environment. Getting rid of the lead is very tough. All that stuff, very negative. That's the obvious side of it. But that operational efficiency that comes from using hydrogen, less storage space in the warehouse, less people needed, less time spent, more efficiency in terms of how fast the trucks go. To fill a hydrogen forklift truck takes 3 minutes. so you can do it in between the changeover of shift. It's a very different thing. So that got us really interested. Now, then we hit another problem, which was interesting to me as well. You know, these are all small companies, they're all young, lots of them are loss-making. So when we started to interact with the company, we spoke to the CFO, gave us a lot of time. They had a poison pill in place. And I was listening in there to earlier about conversations around, you know, governance and engagement. And, you know, sometimes it's all very well saying I'm going to engage with a big, large cap company, but in reality, there's only so much you can do. You know, you can try really hard, you can club together with other investors, but my 0.0001% I'll own in Amazon or Facebook or Google's not really going to get me very far. But with Plug Power, we are today the 4th biggest shareholder. As little old Kames, we're 4th biggest shareholder. And when in March and April I did that work, and Ryan, our head of ESG, interacted with them, they had a poison pill in place that came up in June. And we said, look, we're not investing if that poison pill stays in place. Now, not just because of us, they interacted with some other people as well, and they'd already been thinking about it. They removed that poison pill. So you got the and then we invested. So you got the combination of the angle from the green story, the operational efficiency, it's cheaper and better to do, and the governance story that all hopefully highlights, you know, what the Kames Capital sustainable team is about and how we're investing in companies that are a bit different from the way a lot of other people are doing it. I'm going to look at the time to see how long I've got left. 2 minutes. I have a couple of other sort of general themes. We are bottom-up stock pickers, but similar to what you heard earlier, I guess you're drawn to certain themes. And before I carry on, it's in some ways to answer Robin's question about what are the risks. In my view, the risks are short-term. The long-term, you know, benefits of investing sustainably were highlighted very eloquently before me in terms of these are just good companies, right? You know, they're thinking long term. Where's the negative? The short term risks are you get a value rally and stuff, you know, that's the more dirty cyclicals, and that can be very painful over a quarter, 6 months. But things like demographics, interest rates where they are, and the fact that we can innovate faster and cheaper than we ever could mean that over the long run, you know, these type of asset-light growth stocks and quality stocks that are doing really good things for the world are just going to keep doing it, and they're going to keep disrupting. And if there's one word I would leave you with for investing in the Kames fund, it is disruption. We are investing in disruption. Now that disruption tends to specialise in incumbents, and it tends to specialise disrupting incumbents in pretty nasty, you know, industries, because they're there to be disrupted. If you're doing something bad, you're there leaving yourself open to disruption. If you're not doing it in the best way possible, with interest rates where they are and the, you know, the will of the people that is so obviously there, you know, the combo of the two is powerful. And we've got that real opportunity now. In the old days, these companies used to have to think about, well, we're loss-making and growth, and now they can just, you know, hammer it and go for it and go for growth and disrupt while they can, because money's cheap. I have literally 30 seconds left, so, you know, some of the things we've got on: healthy healthcare, healthier living, things like Planet Fitness, Basic Fit, Shimano, and then we look for growth companies, maybe more specific, like Everbridge, which is doing critical management, safety, you know, and as we get more disasters, we need more help, and they help there. And look, I'm done on 10 minutes now.
Thank you very much for keeping to tell. Now pass over to Luciano.
Okay, so good morning everyone. So at Big Day we have been managing thematic equity funds for over 20 years. We're quite well known for our water strategy, and sustainability has always been very important for us. So this strategy that we call GEOS, the Global Environmental Opportunities, that I manage, is 5 years old. And so it is global. So for us, it's really an approach for global equities, and it focuses on environmental solution providers. So the improvers, the leaders, doesn't matter as long as they have a solution. And what is important for us is also the secular growth argument and the impact. Although our primary objective for all of our thematic funds is the financial risk-adjusted return. So sometimes we say dual objective. The primary is the financial, the second is the environmental impact. What is important for us is also that the investment universe is very diversified. And I will go into some details because we use a scientific framework as a base, the Planetary Boundaries, and that's important for us. The diversification is important because we don't want to offer our clients a portfolio that is overly volatile. So we have focus, we have conviction, 50, 60 stocks, but we don't want to offer something that has a beta of 1.2, 1.3, because also that's unnecessary. We want to look at technology innovation. We don't focus too much on very early stage technology. That's just a choice. We prefer to have technologies that are a little bit more further up the maturity curve. So if we have this next few minutes, what I can do is I can give you an overview of the Planetary Boundaries and then give you some examples of companies that develop these technologies. So the Planetary Boundaries, if you haven't heard of this framework before, is simply a framework that a group of scientists has developed in 2009, coordinated by the Stockholm Resilience Center. And it just tells us that there's 9 dimensions for the ecosystem that matter. And climate change is one of these 9 dimensions, and historically we've talked a lot about it, but the other 8 are equally important. So the biodiversity is another very important one, the nitrogen cycle, the freshwater cycle, the chemical pollution, the land change, the deforestation. And so every one of these 9 dimensions has a boundary. And the scientists, they give us this boundary. And they tell us if you go beyond the boundary, you have the risk of nonlinear change. And if you stay within the boundary, then you have a sustainable business. So what we do here is we look at all of the 9 dimensions and we identify the businesses that satisfy 2 conditions. One, that they themselves stay within the boundary. So these are businesses, broadly speaking, that they don't overconsume natural resources to exist. But then that's not sufficient. They also have to provide a solution for the rest of the economy, if you want, to be sustainable, to go within the boundary. Some examples. So climate change, I won't talk too much because it's very well known, but let's take the nitrogen cycle. So it's one of the big problems that is related to industrial agriculture. So if we over-fertilize, the nitrogen doesn't get absorbed by the soil, ends up in the rivers and eventually in the oceans. We have seen the emergence of dead zones all over the world. This summer, the largest one ever observed was in the Gulf of Mexico, was 10,000 kilometers. And that means a very tough situation for fish and also becomes toxic for humans. What is the angle there? Is to find solutions in organic food. I'm very excited about what we're seeing in terms of synthetic meat right now. There's only Beyond Meat that came to the market, but we know of many other companies that will come through. Early stage, but it's quite exciting. So just one example to say that we really want to look at the environment at 360 degrees. What we do is we take this planetary boundary framework, we couple it with the life cycle analysis framework. So we collaborate with the Stockholm Resilience Center, with the Carnegie Mellon University in the United States, and we end up with a universe that is around 400 stocks. So this is where we pick our portfolio holdings. So 400 is broad enough for us. We categorize it, we use 7 categories, broadly speaking. And so we have energy efficiency, we have the renewables, quite obvious, waste management, water. The one that maybe is more interesting is one category that we call dematerialized economy. And maybe I can spend a couple of minutes describing it. Our view is that, so we have 2 broad sets of issues. Either it's resource efficiency issues, so natural resource efficiency issues, or pollution control, or both. If we look into the natural resource efficiency, Any technology that helps the economy consume less raw materials, energy, water per unit of GDP is something that we can look into. In the manufacturing space, we have seen a huge amount of technology related to virtualization, related to simulation, that for us is very much an environmental technology. So examples here would be ANSYS, which is a US company leader in simulation, or even Autodesk, or Dassault Systems. So we look at these software companies, and we have been invested in these companies now for 5 years, since the beginning of the fund, and they've been great performers. And the market will look at them as technology companies. The companies themselves will not even report their environmental impact, because that's not their language. They just do technology, they do software. But then when we look at what the result of their products is, the result is significant savings in terms of raw materials. So simulation is becoming more powerful. We can design, produce, and test using the virtual board. So on the design side, we can choose the best materials up front without the need for physical prototypes. On the testing side, we can do crash tests that are virtual. So I used the example of Airbus. A few years ago, they had to actually manufacture the planes and ran them into walls to see what happened. Now they can start to simulate a crash of an entire aircraft in 3D world. So it's quite exciting. Autodesk is also a good example there. I've known the company from my engineering days 20 years ago. CAD manufacturing. So CAD is a software that allows it to design objects. But they're investing more and more in software for the building sector. So the whole theme of building information management that allows architects to design buildings that are self-sufficient from an energy perspective. So technology, innovation, very important. We prefer to stay away from technologies that is too early stage. So we have a bit of a quality bias in the portfolio as well when it comes to free cash flow generation and return on capital. And again, it's a global equity approach. So when we take a step back and we look at the world and where it's going, we know that growth is going to be scarce. We want the secular growth. And the environment is a great way to, it's a great angle to have, because we know that businesses that are not sustainable will face headwinds, regulatory headwinds, policy headwinds, and on the flip side, our holdings are likely to have tailwinds. And we're very encouraged by the huge amount of awareness that we're seeing these days, which is actually even different than compared to 10 years ago. We see Greta, that's just one example. Young people, they're mobilizing. We see private companies investing more. We see consumers changing their habits. And then, also governments. Maybe not everywhere, we have exceptions. We have the US, which is going the other way, but we think that the government policy is going in the right direction. So even in the US, we expect that soon we'll see some change to where the government is going. So it's really a convergence of events that make this a very good time to look at environmental investing for global equities.
Okay, no, thank you. And again, it's been a long time there. Those were very interesting introductions to their respective processes and funds. Now open it up to the floor, and if you have any questions, I'd like to hear those now.
Are we solely focusing on equity investment here?
Yeah.
Yes, that's right.
Yeah.
It's not relevant then.
Okay, fine. Anyone else with a question?
Just in general, I think I understood about too that I could hear about your funds, the focus that you have. How do you deal with these subjects for the rest of the organization? if you have a client that is just investing in European equities across the board, they can't afford to, I mean, like what do you do with fossil fuels and with other sectors that may not be so tailored for a very focused fund? Your firm view, what would you tell your clients? Do you invest in those stocks, or you simply do not have any funds and any clients that do not align with this?
I think you could also broaden that question out about how integrated is that and also things like ESG through the whole investment process across the whole suite of funds.
And that's for all of you, obviously, just giving you.
Shall I kick
start
off?
off at the
So within Rathbones, we've got a fairly broad church of clients. So we've got the unit trust division, we've got Rathbone Investment Management, which does discretionary investment portfolios. And they will range from clients who aren't at all interested in ESG issues right through to very, very complex ethical, sustainable mandates, and that's dealt with by the Rathbone Greenbank team, which I sit within in the research team. I would say that across the board, ESG is looked at as a risk factor. So where you have issues that are financially material to companies, that will be looked at just as a matter of course, as it's part of the investment process. And the other approach that really kind of runs across all of our investments, regardless of kind of client-specific mandates, would be the stewardship and engagement side of it. So from a really kind of basic perspective, at the corporate governance level, are these companies well run? Are the directors operating in the long-term interests of shareholders and other stakeholders? But also broadening out to wider social and environmental issues and how we can influence companies not only through divestment but through that really active, targeted engagement. And we've got programs on that, on issues from climate change to modern slavery to digital human rights. So a really broad range of issues that can be addressed through that avenue.
I just have really quickly within the unit trust business, Kate says that we have an equity and bond fund that we're sustainable, and we have these a framework. The other funds, we think about this stuff a lot, so they can invest in other industries. But every company meeting we have, we'll talk about ESG a lot because they are material risks to the business. But clearly there's some difference based on the mandates that we run.
I mean, rather than repeat the exact same stuff, because it's exactly the same answer, maybe I could talk just briefly about how that's changed, and I'm sure it's the same. I mean, I noticed from 15 years ago when I first entered the industry, there was a group of clients, the vast majority of that you never spoke about this stuff with, they just weren't interested. And now it's just a scale. So you've got, this, our fund, or whichever fund it is, right at the top of the scale, and the rest of our universe of clients, at a bare minimum getting some sort of discussion. I mean, we're just about to vote on BHP this week, and it'll be something around the environmental impact and a vote against. Higher levels of engagement, high levels of experience doing that. Aegon Asset Management as a whole and the wider Aegon group have a blacklist of stocks we're not allowed, thermal coal, some of the stuff you'd expect, cluster bombs, that kind of stuff as well. So there is an absolute minimum on that scale, and it isn't zero. Some of the clients couldn't care less, and no doubt some of our fund managers and some of the fund managers across the world, let's be honest, some of them couldn't care. But that is becoming not the normal, and 10 years ago it was more the normal.
And Equity Asset Management is a multi-boutique firm, so we have emerging market, we have European funds and global specialties. That's where the thematic funds sit. And so we integrate ESG across all funds, but we have different client bases, so different needs as well. I mean, we also have a sustainable equities fund, which is a best-in-class approach, so completely different from what I just described here, the thematic approach. And broadly speaking, oil and gas and coal, they're not excluded across all of big asset management. It's only within thematics and within this strategy that we have a I like to call it almost like an extra layer of ESG, where we take the E and we use the planetary boundaries to do that exclusion, but it's definitely not across the board.
Thank you. Just as an observation from someone who looks at fund management houses and fund managers, there is a range of how people deal with this, and I think some of the houses here presenting do have good integration through the process. And it's interesting to see other fund management houses who greenwash, just perhaps put a ESG slide at page number 72 and just comment on that. It is something to be aware, but as an observation, I think a lot of the industry are becoming more integrating that across the actual working.
I just think that it's a weird personality split. You really start to understand where we're going and what sort of stocks will actually do well because of the situation. Even if your clients don't care, it's quite an interesting dilemma, whether you educate them and whether you just show them a little bit more, or you tag along and say, okay, fine, here you have, you'll do well for the next couple of years or something. But
it's that. Go on.
So if I may, I think that is the broader problem of benchmarks. And this is why in our thematic franchise, we've always been benchmark agnostic. But the moment that you're measured as a fund manager on MSCI World or on IFI, or in that benchmark, you're going to have oil and gas, you're going to have a lot of industries, and you cannot take huge tilts. So your point is perfectly valid, but it's about benchmarks in the industry.
I'd take it one step further even and say, sustainability adds value over the long run. So whether you care or not, it doesn't matter. You're getting a better portfolio, and there's lots of empirical evidence away from funds to prove that using a sustainability filter. So what if you don't own any oil and gas? Who cares? You'll have a quarter where you get screwed, but over the last 20 years, have you done well owning the oil and gas sector? No. Have you done well owning lots of other price-taking sectors? No. So just don't own them. And if a client doesn't care, take them on the journey and they might care. Same with fund managers, even internally or externally. You've got skeptics sitting within my fund management group, but if they keep seeing you outperforming them, they're going to change their mind because they're hurting in the wallet.
I was just going to take a question from just behind you.
What would you ask of the industry to take those clients on the journey to connect them with your funds?
Question.
Yeah, I mean, some of it is the regulation. So things like having it mandated to actually ask clients about their preferences and their values, I think that would be a massive step forward, because we hear just anecdotally of people who have just been told, oh, that's not kind of an option for you, or a lot of the kind of persistent myths around it affecting performance. And as has been mentioned, the body of evidence is actually showing that it will enhance returns rather than negatively impact them. So some of it's about educating the industry, some of it is about educating kind of the wider population. There was a report released a couple of weeks ago that the DFID had done a big kind of market survey looking at the levels of interest in the UK population for sustainable investing and what the barriers are, and some of the ways that we can overcome them. And a lot of it was about awareness raising within the industry and without. And I think we are, even though we are moving towards a more kind of sustainable way of operating and more awareness of the financial materiality of these issues, we have still got quite a long way to go.
So keep it simple as well. I think it can be, you can tie yourself in knots and it can be slightly overwhelming. You hear different phrases. We meet companies, big companies, that they get confused. So I think we keep it simple for people and demystify it, and the returns thing, for me, are the biggest things.
I mean, lose the attitude that it costs performance, end of, really, one sentence.
Okay, now I think we're coming up to the end of time, so if I can thank our guests, hope you found that useful.